With markets at all-time highs, I want to show you a simple and effective and cost-effective way to hedge the downside risk. So first and foremost, I just want to talk about the concept of hedging. One of the mantras that I love, one of the mantras that I try to instill in my trading every day is this idea of trading around the trade. Build a trade, and for me, I'm primarily a credit trader, and so you're working with delta balancing and you're trying to be as delta neutral as possible. And that never works, right? Or it only works for a very small amount of time. And then the trade does things that you don't want it to do. And you can either just give up and exit the trade, and use stop losses and take the losses, or you can adjust, you can manage, you can hedge those positions. And I like to think of hedging as insurance protection. I just imagine the conversation of somebody talking to their buddy and saying, I've heard about this thing called homeowners insurance. Do you have that on your house, and do you think that's a good idea? I mean, we would all just look at that person like he's a crazy person. We all understand that hedging or insuring things that are valuable to us is considered a prudent thing to do. I think even if most of us didn't have a mortgage on our home and our mortgage companies no longer required us to have homeowners insurance, that we would continue to pay that cost because we understand how prudent it is. Well, I think that it's prudent in our investing world as well. And so I do trade around my trades. I am always either buying or selling calls and puts, generally in the futures market, to offset any risk with those particular trades, balance out my buying power, even out my delta neutrality as much as I can. And I just wanted to show you an example of that because I do it permanently. There's rarely a day in my life as a trader that I don't have a hedge on of some kind. So it's a permanent hedge. And this is the last month's activity here you can see in the E-minis. And you can see all kinds of trades in here if you look at them. You can see puts and calls, and you can see buy and sell. So you can see short and longs, and puts and calls. So it's just a hedging strategy, balancing back and forth, back and forth. Now the interesting thing is that sometimes, rarely do we make money off of our homeowners insurance, right? And it's not designed to make us money. It's designed to protect our portfolio, and that's what a hedge is designed to do as well. If your portfolio is $200,000 and we have a 10% drawdown in the marketplace and you lose 20 grand in your overall portfolio, it'd be nice to have a hedge in place that would have gone up in value by 20 grand. That's the idea. But if you can make money off of your hedge, that's of course even better. If you can make money off of your insurance, then that's nice. And I was up, I've got some commission fees. You got to take those out of there. So basically 4,000 or so that I was up over the last month of trading the ES as my hedge. And there's probably somewhere between $10 and $13,000 probably attributed just to this E-mini hedge that I go in and out of. But that's not really the point. The point is that even though I like that and that's nice, that works for my portfolio size and it works for the risk parameters that are comfortable to me. But a lot of you have expressed the desire to say, hey, I'd like to be able to protect myself to the downside. I'd like to be able to make money if the market goes down. But I don't want to commit the capital on a full-time basis to something that's only going to make me money if the market crashes. Because we know that no matter how overvalued the market is, it doesn't mean it's going to crash tomorrow, right? And so that's what I want to show you guys today, is a very simple, very effective way that you can manage risk in your portfolio, and it's cost efficient. That's the big thing, is it's very, very cost efficient. So there are only 3 rules in the system. There's a trigger, there's an action, and there's your exit points. Okay, so the trigger. What would trigger us to put on this hedge to the downside? Well, when the S&P crosses and closes below the 10-day simple moving average. Okay, so that's our trigger, and I'm going to walk through this and I'll show you this all in live examples here. But that's the trigger. When the S&P crosses and closes below the 10-day simple moving average. What would we do when that happens? When that action takes place, we would go long a 60-day to expiration, 5 delta, 20-point wide put debit spread. Okay, that's a mouthful, I know, but that is the descriptive way to explain what action we would be taking. We would be going long a 60-day to expiration, 5 delta, 20-point wide put debit spread. Okay. Now, the exit on this trade. When would we get out of the trade? Well, there's only 3 scenarios that we're going to run across here, and there's a provision for each one of those. Number 1, A, is that we hit a 300% profit target gain. Now, that's not a hard thing to accomplish if the market is crashing, but we know that the market doesn't always crash, right? So there's other alternatives here to tell us when we want to exit this trade. B would be when we hit a 25% stop loss. So this is a very cost-effective way. You don't have to throw thousands of dollars at this hedge to have it be meaningful in terms of its potential rewards. Now, you need to delta balance this with your other portfolio positions and understand how many you need, but it's not a capital intensive approach to hedging to the downside. So if you put up, $100 into this position and it dropped in value down to just 75, you would want to exit that trade. 25% of your capital is only at risk in this. And so again, very capital effective. And then finally C, maybe 30 days comes, we put this hedge on, 30 days comes and goes. We haven't really experienced a 25% loss in our insurance, if you will, but we haven't really experienced any big net gain either. Regardless of where we're at, 30 days to expiration, we exit that and get out because we're starting to run out of time, run out of value now in that, and theta is starting to erode our position. Okay, so again, the trigger is when the S&P crosses and closes down below the 10-day simple moving average. Our action is going to be go out to buy a 60-day to expiration 5 delta, 20-point wide put debit spread. It's a mouthful for me too. And then our exit would be to get out at a nice 300% profit. That's our profit target. Get out at a stop loss. That would be a 25% loss target, or 30 days to expiration, whichever comes first. Okay, so let's jump into the portfolio. Let's take a look at an example of this. So here we are with the SPX. It's a very, very simple chart. There's just the candles. There are daily candles superimposed on top of a 10-day simple moving average line. So very, very simple here. Now you can see, and we could go into this a little bit more in detail. We could look at a 4-month chart and see this a little bit clearer here, but you can see if we pull back to a 1-year chart for just a moment that a couple of things happen. Number one, you don't have 100% accuracy with this signal. Now, that's sort of comforting by knowing that we don't get 100% accuracy with any signal that is out there, but it's pretty darn accurate. And the fact that it is so cost effective doesn't really hurt us that it's not 100% accurate. But you can see it's pretty darn close. There was a finish below the 10-day simple moving average, and that would have resulted in a nice trade. That was another one that would have resulted in a nice trade. That one would have been a good one. That one touched it but moved up above, touched it but moved up, but finished up above. There was a signal that would have worked. There is a signal that would have worked. You can see a couple of signals in here that probably wouldn't have worked. That did close down below. You can see it push right back up to that in the next couple of days. But then if you would have held that, then it would have worked, right? So again, as long as it's above that, we hold that. And that probably would have worked as well. There's a signal that touched below, but it didn't close below. Didn't close below. There's one that didn't close below. There's one that did close below right there, and it reversed in a couple of days. So that would have been a false signal right there. I think that's one of the first ones we've seen so far. There's one that closed on it. That closed below, and that might have been an okay signal, but it certainly didn't last for very long. This would have been a good signal right there. That would have been a downturn in the marketplace. That was a good signal right there. So you can kind of see these, and we'll pull in a little bit closer here so that you can look at those. So that's all we're looking at here is a close, a break below and a close below. That close below is critical, right? You can see several of these. I was trying to look at, well, there's one right there. You can see that candle right there. It was below the 50-day moving, or excuse me, the 10-day moving average, but it closed above, right? So that would not have been a signal. And so here we are in the marketplace today. The market has just absolutely been gangbusters here lately. So we're not even close to the 10-day simple moving average. We'd have to see a demonstrative pullback here to even get close to this. But that increases our odds. That revision of the mean increases our probabilities of success with this signal. So anyway, let's say that we did break down below that. Okay, that we're there. We see it. It breaks down below. We could go to our table, and we want to go out 60 days. And again, the estimates here, or the rules rather, that I've given you, are going to be a little bit flexible with them because we're not always going to hit the exact marks, right? But this would be the closest one here. This is an AM expiration. I don't want to deal with that. So we're going to go to these June 11th expirations. That's 50 days out. That's as close as I can get on that. And then we are going to go down. You can see this is where the market is right now. The brown line shows our expected move. There's a little bit of volatility potential in the marketplace. And so, yeah, maybe we want to hedge this, right? So I'm going to come over here. I'm going to change this to delta. Now, when you go out 60 days on an options trade, you're probably going to find multiple 5 delta trades, 10 delta trades. You'll see multiples of these out there, okay? So when we come down to a 5 delta, let's take, and sure enough, you can see right there, there's 1, 2, 3 that we could choose from. So one of the other things that I like to look at is volume. We can look at volume. You can see volume is really more focused right down there. And then also open interest. I want to go look to see open interest. And again, you can look at those and you can say, okay, I'm probably going to go with this 5 delta right here because that's where the current action is. Okay, and so we're going to do a 5 delta put debit spread, and again we're looking at a 20-point wide. Now we're not always going to get strike prices again that meet our perfect criteria, but it looks like we could do it here. So again, we would go ahead and we would buy the 34.50, and then again we're looking at a 20-point wide spread. So I'm going to be as close as I can get is probably 25. Okay, that's as close as I can get because of the spreads. You got to work with what strike prices you've got. And so there's my trade, and you can see right now, that would be about a $70 trade with a max profit of $2,400. That's a pretty good hedge, right? Now, what are the chances of achieving that max profit? Not very good. Not very good, right? Because that's a long ways away from where the market is. But we don't need to get max profit on the trade. We simply don't need that. All we really need, well, let me go ahead and remove some of the other trades that I've got going on in here. There we go. All we really need here is the stock to hit the levels down here that we want on this orange line. Okay, so there's a couple of things going on here with this hedge that you can see. This is obviously at expiration. This hard and fast line right here, going up through here, this hard and fast line, that's our profit and loss at expiration. So you can see a couple numbers there. You can see at expiration, P&L at expiration, and P&L theoretical. Okay, what we want to focus on is the theoretical P&L because the likelihood is that we are not going to hold this trade to expiration. And so you can see right here, if we come back up, there we go, let's try to get both of them into the same window. That little flag right there, that's where the market is. And this orange line, you can see how this trade would ramp as the market falls. So again, we've got a $70 trade here. We've got a $70 trade that, let's say that the market comes down to 3,700, that $70 trade goes to almost $400. If it goes to 3,500 now, it's almost $1,000. It's pretty hard to find opportunities where you can put $70 to work that have the potential to make almost $1,000 in profit back. And if you are incorporating these hedges into your overall portfolio with the mantra that we use, which is trade around your trades, continually trading around your trades, and using hedging strategies to bring in credit, right? Every single day I'm trying to sell some type of a credit trade to bring in income. If you're peeling off $70 of that and all you're devoting to your hedge type trades are income from your other credit trades, then it really is the best of both worlds. If it works, that's awesome. If it doesn't, no skin off your nose, right? It doesn't really matter to us too much. So that's the idea, guys, that I wanted to share with you. Again, the rules are pretty straightforward. The trigger is when the S&P crosses and closes below the 10-day simple moving average. The action is we go long a 60-day to expiration 5 delta, 20-point wide put debit spread, and we exit when we hit a 300% profit, hit a 25% loss, or 30 days comes and goes regardless of the result. Hope that helps you guys who are not continually hedging, consistently hedging like me. You don't want to add that capital allocation to your portfolio, and I get that. This is a good way to look for opportunities to find out when and how to hedge to the downside.